Let's jump right in. Today, we're tackling a massive roadblock that pretty much every ambitious real estate investor hits eventually. And more importantly, we're going to show you exactly how to smash right through it. We're demystifying how savvy investors scale their property portfolios rapidly without relying on their personal income, tax returns, or W-2s. If you want to know how the pros actually finance their properties, you're in exactly the right place. So let's start with a very familiar and, honestly, a very painful scenario. You're ready to buy your next rental. You've got momentum, but suddenly, bam, you hit a lending wall. Why? Because your personal income doesn't line up neatly with what a traditional bank wants to see. Maybe you're self-employed. Maybe your CPA brilliantly optimized your tax returns for deductions, which is great for your tax bill, but it makes you look practically broke on a standard loan application. Or maybe you just don't want your ability to build a massive real estate portfolio artificially capped by the salary on your W-2. This is what we call the conventional wall, and it's incredibly frustrating. Conventional lenders focus almost entirely on your personal paycheck. They demand perfect W-2s, strict tax returns, and a super low personal debt-to-income ratio, or DTI. Every time you buy a property using conventional financing, that new mortgage gets stacked directly onto your personal debt load. Very quickly, your DTI gets skewed and the bank just cuts you off. They unfairly cap your growing business because they're applying strict traditional consumer lending rules to a commercial real estate strategy. Okay, let's dive into this because this is exactly the problem our topic today was built to solve. Enter the DSCR loan. DSCR stands for Debt Service Coverage Ratio. At its core, a DSCR loan is a type of investment property financing where the lender qualifies you based on the property's cash flow, not your personal income. This is a radical paradigm shift in the lending world. You're essentially forcing the property to do the heavy lifting on the loan application, rather than carrying that immense weight all on your personal financial shoulders. And that brings us to a fundamental question, and really the core philosophy of this entire explainer. Can this property afford this loan? Instead of the underwriter putting you under a microscope and asking if you, the borrower, can afford the loan, they look entirely at the asset itself. That single, powerful shift in philosophy changes everything. It completely eliminates the need for personal tax returns, W-2s, and employment verification entirely. The property either generates enough rental income to cover its own mortgage payment, or it doesn't. Period. And this brilliantly illustrates the night and day difference between the two worlds. The conventional loan is obsessively focused on you, the borrower. It requires mounds of paperwork and gets trapped by your strict DTI. But the DSCR loan, it focuses entirely on the property. It's based solely on cash flow, requiring absolutely zero personal income verification. It frees you from the trap of personal debt load dilution, allowing you to scale your portfolio as fast as you can find profitable, cash-flowing deals. So let's look at the simple math behind DSCR. I know whenever we talk about commercial financing, it's super easy to get lost in the jargon, but you really only need to understand two key variables here. The formula is honestly just simple addition and subtraction. First, we have the net operating income, or NOI. This is simply the property's gross rental income minus its operating expenses. And when we say operating expenses, we mean things like property taxes, insurance, maintenance, and property management fees. Notice that this is calculated before you pay the mortgage. That's an absolutely crucial distinction. The second variable is the annual debt service. That's just a standard way of saying the total yearly cost of the loan, so your principal and interest combined. When you divide that net operating income by the annual debt service, you get a ratio. And the most important baseline number to thoroughly understand here is 1.0. A DSCR of exactly 1.0 means the property's income perfectly covers its debt payment. It is the literal break-even point on paper. If the ratio drops below 1.0, it means the property doesn't fully cover its own mortgage, and you'd have to reach into your own pocket every single month to close that gap. Now, what's really interesting about this slide is this specific target range right here, 1.15 to 1.25. While 1.0 is break-even, lenders don't want you just breaking even. They want a buffer. This range is the lender's sweet spot. If your property's cash flow produces a ratio of 1.15 to 1.25, it means it brings in 15 to 25% more income than the loan actually costs. That buffer gives the lender the exact security they need to confidently approve the loan without ever glancing at your personal paycheck. Up to this point, this probably sounds like a total real estate cheat code, right? But as an informed investor, you know there's no free lunch in real estate. So let's shift gears and ground ourselves in reality for a second. Because the lender is taking on more risk by completely ignoring your personal income, there is a cost. We need to look closely at the pros versus the trade-offs so you can make a truly informed decision for your portfolio. Let's weigh these out. The speed and simplicity are unmatched. You're not hunting down 3 years of tax returns. There's no cap on the number of properties you can hold, which is absolutely vital for scaling. It's perfect for non-traditional income earners, and most importantly, the property does the work for you. But we have to look at the trade-offs. You're typically going to see higher interest rates compared to a conventional loan. You might encounter prepayment penalties if you try to sell or refinance too quickly, and the closing costs can definitely run a bit higher. It's a balancing act between incredible flexibility and the realistic costs of capital. Now, the biggest trade-off you need to prepare for is the barrier to entry. You're generally looking at a 20 to 25% down payment requirement. Because lenders aren't verifying your personal income to ensure you can pay them back if things go south, they require more skin in the game up front. The property's equity acts as their primary safety net, so you definitely need to bring more cash to the closing table compared to financing, say, a primary residence. So, what should you take away from all this? How do you actually apply this information today? It all comes down to running the numbers on your specific deal. If you have a property in mind, don't guess. Calculate it. Figure out that net operating income, divide it by the expected annual debt service, and see exactly where your ratio lands. That one simple, empowering calculation will reveal instantly if a DSCR loan is a good fit for your next acquisition. If you're tired of being held back by conventional lending limits, a DSCR loan is a really clear path forward. It lets a great cash-flowing property stand entirely on its own 2 feet, ensuring your personal W-2 never dictates your wealth-building potential. Because when you find great deals, the financing should accelerate your growth, not halt it entirely. If you're ready to break through that conventional wall, it's time to take action. Reach out directly to Kay Wittmann, who is a specialized expert in DSCR loans, to review your numbers and get your funding secured. You can call Kay at 310-903-7916 or just shoot an email over to k.wittmann@loanfactory.com. Kay's NMLS number is 273-7675. Take that momentum, reach out, and start scaling your portfolio on your own terms. Because ultimately, you have to ask yourself, is your next property strong enough to speak for itself?